All right, now to our first conversation. Most listed companies have released their results to the public from third quarter to 9 months result for the year. I've seen, bumper revenues in some financial reports showing growth compared to the previous period. But today we'll be looking at results from Nigeria's manufacturing sector. Our focus is on return on equity. That's the ROE for most of these companies. ROE is a measure of the profitability of a business in relation to its equity. That's for every Naira and dollar invested there by shareholders, how the business is able to make money from that. Well, let's look at, we'll be looking at some data. But joining us to discuss this is a manufacturer, Mr. George Onafowokan, is the MD, CEO, Coleman Wires and Cable. Join me right here in the studio. Great to have you.
Good to be here, laddie.
Yeah, so as I said, we have data. And from some of the listed companies, we see Nigeria Breweries ROE for the 9 months in 2024, 173% down. Cadbury Nigeria PLC, 34.30% down. But we see the cement giants able to eke up gains, 12% for Dangote Cement. Boa Cement added about 13.35%. Yeah, and I did see that headline earlier today about cement prices going up. So I guess that's, looking good for the cement, manufacturers. But talk to me about the importance of ROE and, what this metric says about the health of a company.
Now, you spoke to the point earlier today, basically talking about the invested amount in capital vis-a-vis the profitability of that business. It's very simple and well explained. But what jumps at you on these four companies? Just by looking at it, negative, negative, positive, positive. What would jump at you? FX, local, local. It's the first thing that should jump at you.
Right.
If you look at where the actual cost goes into, this is quite highly import dependent, these two companies. This is highly local dependent in terms of raw materials. The positive will come out because they are not as highly dependent on import as these two are. So the majority of the losses here came out from the FX losses. The upside here is companies literally that are majorly dependent on local resources. So you actually, the first two eye-catching thing that you actually should look at is where is their cost of funds coming from?
Right. Now,
that shows majority of the people or companies that are dependent on importation will all be showing ROEs of negatives, which is their capital, because their losses that would have been generated from FX-related losses would be differential, because these guys here are not literally importing as much. So their FX-related losses will be a lot smaller. This will be large. So if you look at most companies that are related to that, they're showing massive negatives on FX-related losses, and that literally has dropped their profitability, if not in cases, put them in negative. Some has literally wiped off their total capital base and even their positions, talking PZ, Cousins, and the rest of them, which had to show a global indication of what Nigerian impact is to its end result gain. And so when you look at those two, it tells you, look, if you're a company that has heavy dependence on raw materials local, you most likely will see a contraction, but not in the same level of these other companies. Now, so that will give the indications to the market where we should all be looking at. Everybody that is 60, 70, 80% raw material dependent on FX is massively exposed to a FX-related loss, which at the end of the day, their bottom line will come down. It will contract drastically. Now, companies that are locally based raw materials would have a contraction, but the contraction will be dependent on the small amount of maybe 20, 30% that is their FX-related exposure and risk. So it's a fantastic display, but it just tells us where we're going. So you actually know where your contractions are coming from, and invariably it tells the government, look, where the problem is. Now, if you look at this, and these are also not small employers of labor or manufacturing in sector. Now, this begs to ask the question, why, if you speak to others in other countries, it's shocking when you actually come into Nigeria and you find that raw materials, we're paying duty on it. For what reason, I don't know. The whole point sometimes is to backward integrate. But when you don't have it, you should turn your country into a processing country. Now, Nigerian breweries, Cadbury's have export potential of the same products they're making in Nigeria. They don't have to build the same factory in Nigeria, in Ghana, in Benin, in every West Africa. I can turn your country into the hub of supply. The same way Nigeria lost some of its shares of industry to Ghana at a point where everybody was moving their factories to Ghana, because there's ETLS, which is ECOWAS Trade Liberalization Scheme, that allows me to duty-free export back into your country. There's nothing you can do about it. We agreed to that trade agreement. So I can do that also. Now, but what would increase this type or reduce the figures is to actually change the dynamics of fiscal policy to encourage raw material. The same way we actually, if you look at the impact that the government looked at on food and related agricultural products, right, and introduced a 150 days window of zero import duty. I'm sorry, the question is, if we don't want this to keep going negative, we need to actually put the exposure down, reduce the exposure risk, not only on the FX, also on the raw material, so that these guys are competitive. The reality of life is, if we take our FX position of devaluation today, reduce it, you automatically reduce inflation. So if I take out 5 or 10 or 20% duty on these guys, they reduce their price, I automatically bring down food inflation, drinks, and because these are guys making food. Now, for these guys, it's a different ballgame entirely. Now, when I come here, it's a case of, yes, they're going to still continue to make profit. Because, look, let's be sincere. These guys are producing elastic. There's elasticity in their product. No matter what price they call cement, a lot of us are going to buy. The question is, how competitive is that market? So the direction for government will be different here. Should be, how do I enable more players, as many as possible, right? So that this really becomes competitive. Because we all scream and say cement price is going up. I really cannot understand the argument.
Because we've seen the prices of even how that's impacted. And
if you go to, if you actually look, good thing is these are traded companies, so right, you can actually see their bottom lines. Their bottom lines are still going up, although not as much as they expect it to, because yes, cost of funds have gone up, financing cost has gone up. That is why you're seeing that marginal increase. Otherwise, they'll be showing a bigger figure on RAE.
To the upside.
Correct, right, to the upside. That's the reality. So, but they keep making the argument that they have import, okay, for machinery, we have to be fair on them. They do have some certain amount of import. But in terms of the increases, if you do a comparative analysis between our products and products elsewhere, it should have some differential, but not too much. So we need to actually encourage manufacturers more in certain sectors, and now look at other sectors in terms of food, raw material availability, how those sectors can create. So in everything, I always say, look, you need to have a balance between the monetary and the fiscal. Now, this is a fiscal issue. It's not a monetary issue, because if you throw money at it, it's not going to solve the problem. But if I throw some fiscal policy immediately on it and allow Cadbury, Nigerian breweries, and some of these other players to actually reduce their cost of dutables, I will instantly get their costs down, and they can be a bit more competitive, and they drive their own prices down, because they relate more to food and drinks. So it's all about, and when you look at our inflationary figures, the headline figures that have been literally bombarded over the years now, in the last 2-3 years, has been food related. So anything that I can bring down on that area will bring down my total cost and actually improve this guy's negative.
And it's quite interesting, you know, from the solutions you prefer for these parts and this part, I don't hear anything about rate hikes, which is great. But we'll take a break now. When we come back, we're going to analyze the impact of, you know, the rate hikes we've had, you know, so far. We'll continue the conversation right after this break. Just stay with us.
It's Konga Yakata, our biggest sale of the year. Every day till November 30th is Black Friday. Shop genuine computing, Starlink kits, electronics, mobile phones, and many more at up to 85% off. Powered by the original manufacturers. It is cheap and safe at Konga, the e-commerce group you trust.
Welcome back, and we're still analyzing results of manufacturers in Nigeria. I still have with me Mr. George Onafowokan. There's a MD CEO, Coleman Wires and Cables. Thank you so much. And, you know, all that you brought up about those companies, eye-opener, you know, definitely. But I'm still thinking back to fuel subsidy is gone and, you know, collapsing the FX market, allowed the Naira to float at this time. I'm wondering, do you think our economic managers and this government actually, you know, foresaw the impact of floating the Naira? Because we keep hearing the same tune when you want to look at the financial results of most of these companies. FX losses, FX losses, FX losses. Do you think the government actually saw this coming? And for salary earners and, you know, us being an import-dependent country, did they see the impact of somebody that used to earn about 350,000 Naira? It was equivalent to about $1,000, you know, at some point. But that 350K is not $1,000 right now. Do you think they saw this coming?
It's a fair question. Now, luckily, I'm not a politician, so I'm going to actually answer it truthfully. One, I believe they saw it coming. Two, they erroneously started wrongly. Now, let me explain that. Everybody knew, because if you look at their campaigns prior, all the campaigners literally said the same thing. We're going to remove fuel subsidy, we're going to harmonize the FX-related situation. Now, the question is, nobody was doubting that that was a necessity. The question is, how do you implement it? It was the implementation they got horribly wrong. They started too early. They did not. Normally, you would have expected them to have gotten into government and started the easing over time. Now, unfortunately, the May 29th speech literally caught everybody off guard, right? And with all good intention, I think, from the president. But that statement became a fiat. The next day, everybody went to the pumps, literally trying to pull out as much. The system could not cope. So automatically, what happened the next day? Prices were jacked up because they didn't have the resources. You know, Nigerians were literally positioned ourselves. Someone has just told you that the fuel subsidy has stopped. You don't need to want to know what the final price is. You just rush to the petrol station and buy the fuel at that price. So that's what literally happened. Everybody in Nigeria went to the petrol station the next day. Not that they planned for it, not that the government was ready for it. It was just literally a statement, which for me, I think the president was trying to say, this is what I expect to happen. Now, but they left the part that Nigerians are literally forward thinkers. And they would rather save the money today and chop the garri now and literally eat well tomorrow. So that's what happened. Now, the aftermath of that was, now what do we do? And those are the implementation that literally has taken more time than it should. They're getting there now. Let's be fair on them. But we've literally lost over a year to what they were prepared for, but not timed prepared for. Now, so that has failed. Now, invariably, what you then had was an impromptu decision that literally led to an increase in inflation because, boom, you went from 160-something, bang, to 600 now. Then you had an FX Naira that went from 400, of course, fake 400, now to the real, from about 600 and something. Now we've got to 1,700 plus. Now, Nigeria moves easily on FX-related devaluation. Naira, literally, inflation will be impacted. If we get Naira back to 1,000, believe me, inflation will drop almost 10 basis points. All of us know that. So how do we look at it? So the first thing was stabilization, which took longer than expected. Now, stabilization has started happening in terms of monetary policy. I think we're in the right direction of monetary policy. On fiscal policy, we're now coming in line. Now, I'm optimistic. Unfortunately, the two impacts have ended up with increase in interest rates to try and also deflate the inflationary effect of an increase in inflation, to try and calm it down. Now, You push interest rate up, the knock-on effect is onto the manufacturers and the whole sector. Cost of fund to everybody. If you look at everybody's books in the last 1 year, financing costs are shot up, cost of sales have shot up because everything has increased in price. At the end of the day, there's nothing you can do about that. For most manufacturers, it's a disaster period because they're just literally having to either scale down or scale down their actual production capacity and capacity utilization. In Nigeria, as the country has dropped, that's basically sees, if you look at the today, the Purchasing Managers Index, you're now down to 46.9% from 49.9%. The mere fact that we're even below 50 should be worrisome because it's contraction. Normally, at a PMI index, you don't really want to be below 50. You want to be above 50. But today, we're now below 50. And we're contracting. And
that's the biggest drop. If you can put that up for me, that's a PMI for October, the Purchasing Managers Index there. We see that 46.9 points October from 49.8. And 49.8 was really close to 50.
Yeah.
But that's a big drop.
It's a big drop.
For October. And when I look deeper, into what Stanbic there had to say about the PMI, I saw most of these companies had to employ more.
Yes.
And at the same time, they had to also increase salaries.
Everybody did.
And definitely that's, adding into input costs.
Correct.
At this point, which will now drive out, drive up the selling price.
So because you see, the reality of this, what is this PMI study? Basically, your production, your employment, your purchasing, literally all costs related to your supply chain. Now, if all that goes up, there's no way this will not come down. So it's an average survey of all the supply chain elements that creates this figure. Now, in literary terms, it means where you get my cost of employing labor has gone up. My cost to production has gone up. My cost to supply chain has gone up. Now, by the time I take that and take the average, this as contractor, I'm buying less because those costs has gone up. Now, the contraction meaning that, and the disadvantage of this is literally it's telling the market where we're going. So now for anybody in the system today, in the structure, will be literally making their decision based on a contraction. Now, I will spend less. I will borrow less. Because now I'm seeing the market that I'm dealing with, my supply chain is contracted. So invariably it means the market is not growing. Now, fact is everybody from January or even end of last year has increased wage bills. Now, if you're increasing numbers, yes, we're beginning to go back to a little bit of normalcy in terms of employment. We're beginning to increase. As I said, there's a bit of rebalancing going on, but it hasn't taken off the problem. But it will take time. And that's sometimes where my own optimism, never look at Nigeria today. Look at all the figures and look at Nigeria tomorrow. You will most likely have a better answer than looking at today. We most of the time look at today. In my own view, and this is a personal view, so let me know, this would eventually go back up. But it is not today. It is not even Q1 of next year. It's not Q2. I see it more as we get into a better figure by Q4 of next year and start looking at 2026. Now, the question is, how do I position my business for the next 1 year before I see proper growth in the country? And I think it eventually would happen because if you look at it, on the FX-related side, we're seeing harmonization. On the interest rate side, we're seeing a cooling down. There's no reason, really, for me, after this, I don't see any reason why CBN should be increasing any interest because the market literally...
We have another meeting this month.
I can see...
Consensus is
it's
a hold.
It's a hold. The whole market in the world has started dropping. Nigeria cannot go up anymore. But there's also an advantage to us, really. When you look at it, an high interest rate, literally, if the Fed, which is coming down now, the Bank of England has come down 25 basis points, 0.25. ECB is going to come down. The thing is that the way the market trends is that the more they come down, everybody moves out investment into higher yield areas.
So that's the carry trade, right?
Right. So the carry trade for us is that in Nigeria, we expect to see more investment from a cooling down in those areas to higher yield countries like ours, which is literally guaranteed. Now, but it says it plays to the people that have liquidity. Now, if I'm not a manufacturer that doesn't have the liquidity, I'll be crying. If you're a guy that has liquidity, you'll be smiling because you'll be trading up your money, irrespective. Interest rate is high. You have deposit rates well in excess in the 20s. You have FGM bonds and monetary bonds in 28, 27. These are money markets that have fantastic returns. Even if you take off the negative position, I tell people, I say, look, the reality is Nigeria looks more like a savings country, a treasury management country today than anything else. Because for most banks, I don't see them borrowing. Because when you look at the risk, and this is the sad part, the manufacturers need money. But let me be frank with you. The reality is the commercial banks are not lending.
Right, and we've seen CRR, increase about 50% at this point. But just to coast home,
yes.
Now we're running out of time. Is it time for us to say, for our economic manager to say, you know what, let's peg the Naira at this price, at this point, while we're making every other thing work?
I am not...
And defend it with all we have.
I am not a supporter of that. Okay. Because if you peg the Naira, you're going to put a run on your reserves. You put a run on your reserve, we're back to square one. Now, the only thing I think that we should do immediately is peg on certain fiscal policies. I'll peg the Naira against every import. And also, I'll look at those guys that are actually producing and creating wealth and creating employment and see how I can use fiscal policy to actually drive down their own cost also. Pegging the Naira will take us in a circle that we've always been, which is run down our reserves against it, run into zero, go back to the same problem in another 3-4 years. I don't think I think what they're doing...
We've seen our reserves rising.
Look, what you should watch, personally, I think what the market should watch that reserve over the next 1 year. These guys are building up a war chest. My own war chest calculation says 2026. They've got a power float. And at that power float, they can do what you want. So the question is, watch the market. And I think the CBN governor is actually playing that game now. He's letting the Naira slide, but he's increasing his reserve. Look, if you want to develop the Naira, you need a float and you need a war chest. It is not a war chest at 40 billion. It's a war chest at about 50 to 60 billion. At that point, see what that guy can do. And it would be achieved, well, it will take him to almost the end of 2026. He brings out that war chest, he will defend the Naira at whatever he likes. That's the time you'll see this man be able to drive that Naira down below 1,000. But that action cannot happen to 2026 ending. But Q3, Q4, 2026, it will have built up that war chest. That is what the market should keep watching. Keep watching that war chest. When it happens, I'll be in the money because I am playing the Naira game. I believe hold your Naira, wait till 2026.
Right.
You'll smile.
Hold your Naira.
Hold your Naira.
All right, so, definitely quite incredible times, and we have festivities, coming up. So what kind of conversations, are you having, in your industry to kind of make some kind of, buffer for the consumer at this point? Somehow,
I think the buffer we should all be begging for is buffer from the government that trickles down to everybody. Because we as a manufacturing sector are already creating the buffer, really. And what I mean by the buffer is, if you look at minimum wage today, I don't see no manufacturer in Nigeria that has not been above minimum wage since end of last year. Now, we still having governors struggling with what they even want to pay for minimum wage. So we can't say, look, you can't put the private sector in the total burden of a state. The state needs to do something. And if they are struggling, then they should then use that same private sector to create the buffer. Ease the business and the life and the livelihood of the industry, and you will get the buffer guaranteed by December. They just need to do something to actually ease the burden on the manufacturing sector, and the growth of the manufacturing sector will take the burden away from them.
Right, so it starts from up there, then, we have the manufacturers, and we now have some kind of buffer for the consumers with that kind of flow.
That will be the direction.
Definitely. What are you seeing in 2025?
2025, I still see the Naira close to plus or minus 3-4% of where we are. I don't see a massive position of that. I see the position of growth. We will still maintain same similarity in GDP growth, maybe plus another maybe 200-300 basis points, moving it up slightly. I think what everybody will be looking for in 2025 will be stability, and I think that's what the government is also going to be looking for. So for me, play stable, play the market stable, borrow wisely, and you will get to 2025. The aim is 2026 to see the upside.
The upside, 2026. I'm as optimistic as you, Mr. George Onafowokan, MD, CEO, Coleman Wires and Cables. Always great having your perspective right here on Business Morning.
Thank you.
Thank you so much. All right, so definitely it's the start of another trading week right here in Lagos, Nigeria. But let's get a check on how the markets performed. That was last week. That's talking about the local bourse, looking at the NGX and most of the sectors that we track there. We'll see 0.37%. That's for the stock market, 96,924 points. That was Friday's trade, actually. Volume 78% up, 744 million units valued at 16.47. But, you know, it's a brand new week, and we're all going to be looking out for data. That's inflation numbers for last month. We're going to be getting that data out from the National Bureau of Statistics. We're seeing if it's going to be another rise, and also our eyes on the food inflation data. We'll see how that, you know, drives investor sentiment. And for the last rate-setting meeting for this year, that's for the MPC, CBN MPC, we'll see how all of that data is going to impact that going forward. That's the show today. Thank you so much for watching. I'm Ladi Williams. I hand things over to the Sunrise Daily team.
I imagine there was one